Let's dive into a day where the market just completely ignored the big, scary headlines. A day when some really hot inflation news dropped, and instead of crashing, Bitcoin absolutely soared. Now, on the surface, that makes zero sense, but believe me, there's a fascinating story hiding in the data. So let's get into it. Okay, so here's the puzzle we're going to solve. On April 10th, the big official inflation numbers come out, and they are hot. We're talking red hot. Now, logically, that should have tanked risk assets like Bitcoin, right? But the opposite happened. Traders started buying like crazy, and the price just shot up almost instantly. It feels completely backward. So, what in the world happened?
And listen, we're not talking a little warm here. The headline Consumer Price Index, that's the CPI, it hit 3.3%. That was a 2-year high. For an asset like Bitcoin, which is super sensitive to this kind of economic news, this number should have been a massive red flag. But it wasn't.
And the reason it wasn't a red flag is because on CPI day, there are really two different inflation stories being told at the exact same time. And the professional traders, the ones moving the really serious money, they know exactly which story actually matters. It all boils down to the difference between headline CPI and core CPI. Headline CPI, well, that's the one you see plastered all over the news. It's the whole shebang. But core CPI, that's the number the Federal Reserve actually watches to make its decisions. And because of that, it's the number the market really cares about. You see, headline CPI gives you the big picture, but it can be super misleading. It gets thrown around by really volatile stuff, especially food and energy prices, which can just swing wildly from one month to the next. All it takes is a conflict overseas to cause a huge spike in oil, and that's exactly what happened in this case. And here is our smoking gun. A conflict over in Iran sent energy prices straight through the roof. I mean, just look at this. Gasoline jumped over 21% in a single month. That one energy shock was pretty much single-handedly responsible for that scary 3.3% headline number. And this is precisely why the Fed and all the savvy traders, they focus on core CPI. By stripping out those jumpy food and energy prices, they get a much cleaner signal about the real underlying inflation trend in the economy. This is the number that drives multi-trillion-dollar decisions. And here's the punchline. While that headline number was screaming hot, the core number was kind of whispering cool. It came in at just 0.2% for the month, which, get this, was actually below what economists were expecting. And that was the big surprise. That was the real signal the market was listening for. So how did this cool core number instantly translate into a massive market rally? Well, at 8:30 a.m. Eastern Time, the second that data is released, a completely mechanical process kicks into gear. There's no human emotion, no hesitation. It's just pure algorithms and code. In the very first second, literally 8:30 and 1 second, trading algos scan the report. They are programmed to completely ignore the headline noise and zoom in on that core number. By the second, they're already repricing futures contracts that bet on the Fed's next interest rate move. And because core came in cool, the risk of a surprise rate hike was immediately taken off the table. And with that risk gone, capital flooded right into assets like Bitcoin. This all happens faster than you can blink. And what's really cool is we can actually see this happening in real time using a tool called the CME FedWatch Tool. It basically reads the minds of traders by analyzing how they're pricing those futures contracts. Think of it like the market scoreboard for what the Fed is going to do next. And on April 10th, that scoreboard lit up, confirming the market was betting the Fed wouldn't dare hike rates. And this just perfectly sums up the whole idea. As one market analysis put it, the Fed looks through these temporary energy shocks. They care about the underlying trend. The market knows the Fed's playbook inside and out, and on this day, it played out exactly like everyone expected it to. So let's zoom out. Why does this happen? Why does a stable outlook from the Fed, even when headline inflation is running hot, act like a green light for assets like Bitcoin? Well, it all comes down to a really fundamental economic principle. It's all about something called opportunity cost. Think about it. If the Fed isn't hiking rates, the return you can get from super safe stuff like government bonds stays pretty low. So that makes holding an asset like Bitcoin, which doesn't pay you a yield but has way more upside potential, a much more attractive option. You're not really missing out on high, guaranteed returns from bonds, so you're more willing to take a shot on something like Bitcoin.
And hey, this wasn't just a one-time fluke. If you actually look at the data, you can see a really clear pattern. When the CPI report comes in cooler than everyone expects, Bitcoin tends to rally. When it's hotter, Bitcoin tends to sell off. That April report was just a textbook example of this playbook in action. So if you only remember one thing, make it this. The absolute inflation number itself, whether it's 2% or 4%, is way less important than how it stacks up against what people were expecting. The market moves on surprises, and a cooler than expected core reading means the Fed is less likely to slam on the brakes, and that is bullish for Bitcoin. Simple as that. Okay, so that's the what and the why. How can you actually use this knowledge? Let's break it down into a simple playbook for how to think about these big economic data releases. First step, always read past the media headlines and find that core CPI number. Second, you gotta know the consensus forecast before the data drops, because the surprise is everything. Third, remember how the Fed thinks. They ignore temporary shocks. Fourth, pull up that FedWatch tool right at 8:30 a.m. to see the market's gut reaction. And finally, never forget that just taking the risk of a rate hike off the table can be just as powerful as expecting a rate cut. Looking ahead, this is going to be the dynamic to watch. It's this constant tension between scary headline numbers, driven by who knows what, geopolitics, supply chains, and a much calmer, cooler core inflation trend. This tug of war is going to define how the market acts around every single one of these CPI reports. So what's the big takeaway here? Is that the smartest money in the room isn't reacting to the same headlines as everybody else. They're reading the fine print. They're looking at the core data, the numbers that actually drive policy. The market's playbook is surprisingly clear, if you just know where to look. The only question is, are you listening to the right signals?